Good morning. It is Monday, July 21st, 2025, and this is a quick market update with your Clubhouse Insider. First things first, the week has started off on a pretty positive note, about 20 basis points better for interest rates. So that's a great thing. We've been talking for the last couple of weeks just how rates are trying to come down. And so this is another really good step. So as long as we maintain this throughout the week, then hopefully we'll just keep seeing it come down and then get closer and closer to that September rate cut that everybody keeps talking about. So hopefully that comes to be true. So you can see here, this is the Treasury, the 10-year note. This is what mostly, closely follows interest rates. We were over 4.4 last week. And so in the last 5 days here, you can see it just up and down, but here we go to start the week. We're under where we want to be. So what does that mean for mortgage rates? Well, on a 30-year fixed, so a conventional loan, you can see it right here. We were up towards, these are, again, averages. So perfect scenarios, probably buying down points a little bit. So maybe not translating perfectly to an actual quoted rate, but you can see 6.8. And then here we are just a little bit lower, 0.81. But rates haven't all come out yet. It's only 9:30 in the morning here. Rates will update, and hopefully we'll see this start coming down under 6.8 to the 6.7, 6.6 range, and then see what happens from there. So this is fixed, conventional. This is FHA. So again, with FHA, and we're just comparing basically 2 weeks back. So it's been pretty standard, nothing too crazy, but we like this. We don't want to see these big swings. We like consistency, so that's nice. But you can see how FHA, it and VA, the government loans, are often much lower than conventional. So you're seeing a lot of buyers right now taking advantage of that because the biggest difference is all about mortgage insurance. But if you're putting down less than 20%, you've got mortgage insurance on conventional anyway. So take advantage of the lower rates, get in there now. And then when the rates do come down, you can go ahead and, refinance into a conventional later. I'm seeing that as a strategy that people are choosing quite often to get in the home, start the process, buy now, and stop the waiting and stop just wasting money on rent. So then here we go with a VA, same thing, right? You can see it, boom, here we go. So we're right back down. So this has got VA and FHA pretty close together. I would say that that's maybe a little inaccurate. VA does usually come to be a better rate than FHA, even because that veterans loan is the best loan in the market. So lastly, to kind of wrap this up, want to talk to you a little bit about variable income. This is something that's coming up a lot lately, and people getting new jobs or people, moving to the area, something of that nature. If you get $1 per hour offer, that's called variable income often, unless they are guaranteed hours. That's very important. So the definition of a variable income that we're going to go with is income that changes from month to month. So that's commissions, bonuses, tips, overtime, and then especially self-employed, but that's kind of in a different box. So if it's not consistent, where on your pay stubs, 40 hours a week, X amount of dollars, the same week over week over week, then that is going to be determined and deemed variable by underwriters. And underwriters are those pesky people that tell you yes or no on whether or not they're going to give you a mortgage. So over 12 to 24 months is how they usually have to average the pay stubs, the income, tax returns if they have to, whatever it is. There's also these things called written verification of employments. These are all different tools that underwriters will use to try to determine what's your average income if it's also going up and down just like the markets are. So in those cases, we just need to be really sure and get the work started early, because they might not give you as much income as you think, because what they call qualifying income might not be your exact dollar an hour, because you had a day off, unpaid vacation, sick day, something of that nature. Maybe 1 week or 1 month your bonuses were higher than the next, or commissions or overtime, you didn't get as much. All of those factors really, really matter. So it's not a simple calculation to get to what they call qualifying income. That is a big, important word for underwriters. So if you're looking for a house and you have any types of income that sound like this, give me a call and let's make sure we're getting you prepared now so that you can see what an underwriter is going to give you And then maybe we have to go to a different type of box, and maybe that changes your down payment requirements, but we have a different loan product for you, and it may or may not work. So more preparation up front, the more success you're going to have. So let's have a great week, and hopefully these markets stay with us. And if there's anything we can do to help you, please let us know.